$70 billion, 24 trading days. That is how long it took for one of the 10 largest companies in America to go from blue chip to bankruptcy. At 4 in the morning on Sunday, the 2nd of December 2001, lawyers for Enron Corporation walked into the United States Bankruptcy Court at 1 Bowling Green in Lower Manhattan and filed for Chapter 11. 24 trading days earlier, on Friday the 26th of October, the same company had been worth roughly $16 a share. 3 weeks before that, in the first week of October, it had been worth $33. 12 months before that, in August of 2000, it had traded above $90 a share. On the morning of the filing, it was worth 26 cents. $70 billion in shareholder value had vanished. 20,000 Enron employees would lose their jobs, and in many cases, their entire retirement savings. Savings the company had encouraged them to hold in Enron stock. The collapse had nothing to do with the energy markets Enron actually traded in. It had nothing to do with a recession, a competitor, or a scandal that arrived from outside. Enron collapsed because, for at least 4 years, it had been reporting profits it did not earn and hiding losses it could not afford to admit. When the accounting was reversed, there was nothing underneath. The architecture that allowed this to happen was a single accounting technique, entirely legal at the time, combined with a network of off-balance sheet partnerships designed by the company's chief financial officer, Andrew Fastow. The technique was called mark-to-market. By the end of the story, Wall Street would call it mark-to-myth. Enron did not begin as an accounting fraud. It began as a merger. In July of 1985, two regional natural gas pipeline companies, Houston Natural Gas and North of Omaha, Nebraska, combined to form a new entity. Its first chief executive was a 53-year-old Texan named Kenneth Lay, who had a doctorate in economics from the University of Houston and a clear vision of what natural gas deregulation was about to make possible. Under the Reagan-era natural gas deregulation that began with FERC Order 436 in October 1985, the gas pipeline business was about to stop being a regulated utility and start being a traded commodity. Lay positioned Enron to become the merchant of that commodity. By 1989, Enron Gas Marketing was buying gas from producers, selling it to industrial users, and pocketing the spread. In 1990, Lay made the hire that would define the rest of the story. He recruited a 36-year-old McKinsey consultant named Jeffrey Skilling, who had been advising Enron on its merchant banking strategy, to become the chairman of Enron Finance. Skilling had a Harvard MBA and an idea. Enron should stop thinking of itself as a pipeline company and start thinking of itself as a financial company that happened to trade energy. The idea required a specific accounting treatment that no other energy company in America had ever used. Skilling, with Lay's backing, asked the Securities and Exchange Commission for permission. In January 1992, the SEC granted it. Enron became the first non-financial company in the United States allowed to use mark-to-market accounting for its long-term energy contracts. To understand why the collapse was inevitable, the mechanics of mark-to-market need to be clear. When a normal company sells a product, it books revenue when the product is delivered. If a pipeline company signs a 20-year contract to deliver natural gas, it records the revenue each year, as each year's gas is delivered, year by year. Mark-to-market accounting works differently. It allows the company to book, in the year the contract is signed, the present value of all 20 years of future profits at once. For a 20-year custom-negotiated energy supply contract with a single counterparty, there is no daily market price. The fair value of the contract is whatever the company's own financial models say it is. Enron now controlled both ends of that valuation. It negotiated the contracts. It built the models that valued the contracts. It booked the resulting profits immediately, in the quarter the contracts were signed. By 2000, more than half of Enron's reported pre-tax profits came from these mark-to-market revaluations, up from roughly a third in 1999, on contracts that had not yet produced $1 of actual cash flow. Real bonuses were paid on cash that might not arrive for 15, 20, 25 years. The further Enron pushed mark-to-market, the more new contracts it needed every quarter to feed the share price, to feed the bonuses. Eventually, it ran out of contracts to sign. The man who solved that problem, and who in solving it built the bomb that destroyed the company, was Andrew Fastow. Fastow joined Enron in 1990. By March 1998, at 36, he was chief financial officer. Between 1997 and 2001, Enron accumulated more than 3,000 subsidiaries and partnerships, many of them offshore, registered in the Cayman Islands. Within that web, Fastow's office engineered the structures that did the real work of hiding debt. Two private partnerships he personally ran, LJM1 and LJM2, funded a family of Enron-backed entities internally known as the Raptors. The Raptors are where the losses went. The mechanics in plain language: when an Enron asset was performing badly, a struggling broadband venture, a failed water utility investment, a power plant whose true economics did not match what mark-to-market had booked, Enron would not write it down. Instead, Enron would sell that asset at a profit to one of the Raptors. The Raptors paid for the asset with capital Enron had effectively guaranteed, through standby Enron shares, through loans secured by Enron stock, through derivatives written against Enron's own balance sheet. What this meant was that Enron was, in substance, selling assets to itself, booking a profit on the sale, and taking the losses on the underlying asset off its balance sheet into a partnership that, at the deepest level, Enron was guaranteeing with its own shares. As long as Enron's share price kept rising, the guarantee held. The losses stayed hidden. The Raptors stayed solvent. The moment the share price fell, and the moment it fell, the guarantees would be called in, the losses would land back on Enron's books, and the entire structure would unwind in a matter of weeks. By August of 2000, Enron's share price reached its all-time high, $90.75. The company's market capitalization stood above $70 billion. It was the seventh largest corporation in America by revenue. Fortune magazine named Enron the most innovative company in America for 6 consecutive years, from 1996 through 2001. Industry analysts publicly attached buy ratings. Sell-side reports praised the company's transformation from a regulated utility to a financial firm. Investment banks competed openly for Enron's underwriting business. Inside the company, the senior leadership knew what was actually on the balance sheet. In February 2001, Jeff Skilling was promoted from Chief Operating Officer to Chief Executive Officer, with Ken Lay remaining as chairman. On the 14th of August 2001, 6 months after taking the job, Jeff Skilling announced his resignation. He cited personal reasons. He had sold $66 million of Enron stock in the years leading up to the collapse, much of it in the months around his departure. The press accepted the personal reasons explanation. The stock fell from $43 to $36 in the week that followed. Inside Enron, a senior vice president named Sharon Watkins read Skilling's resignation, walked back to her desk, and wrote a memo to Ken Lay. 7 pages. The line that history would remember: "I am incredibly nervous that we will implode in a wave of accounting scandals." Lay referred the memo to Enron's outside law firm, Vinson & Elkins, the same firm that had helped structure Fastow's partnerships. He asked them to investigate. On the 15th of October, they reported back. Nothing, they concluded, warranted a wider inquiry. 6 weeks later, the company filed for bankruptcy. The cracks began to widen in the open on the 16th of October 2001. On that Tuesday, Enron released its third quarter earnings. The reported loss was $618 million. Inside the same release, buried in a footnote, Enron disclosed that it was taking a $1.2 billion reduction to shareholders' equity related to partnerships in which Enron's CFO had a personal financial interest. The next morning, the 17th of October, the Wall Street Journal published the first of what would become a sequence of front-page investigations into Fastow's partnerships. The phrase LJM appeared in print in the financial press for the first time. By the 19th, the headline was that Enron's chief financial officer had personally made millions of dollars from that partnership. On the 24th of October, Andy Fastow was placed on leave. The next morning, Moody's Investor Service, the first of the two major credit rating agencies, downgraded Enron's senior unsecured debt rating. The stock closed at $16.41, a drop of more than 70% from where it had traded 6 weeks earlier. On the 8th of November, the company announced it would restate its earnings for the previous 4 years. The cumulative reduction came to $586 million in previously reported profits. Profits that, the restatement now acknowledged, had never actually existed. On the 9th of November, Enron announced an emergency merger with its smaller Houston rival, Dynegy. Dynegy agreed to pay $10.41 a share in stock, an $8.5 billion equity deal, with Dynegy assuming roughly $15 billion of Enron's debt, contingent on Enron's debt rating holding above investment grade. On the 28th of November, Standard & Poor's, the second of the two agencies, cut Enron's rating to junk. The Dynegy deal collapsed within 24 hours. On Friday the 30th of November, with the Dynegy deal dead and the company's commercial paper effectively unrollable, Enron's directors made the decision that had been inevitable for at least 3 weeks. They authorized the Chief Financial Officer's office to file for Chapter 11 bankruptcy protection. At 4 a.m. on Sunday morning, the 2nd of December 2001, the filing was submitted in the United States Bankruptcy Court for the Southern District of New York. The case, in re Enron Corp et al., would remain the largest corporate bankruptcy in American history until WorldCom filed 7 months later. $63.4 billion in stated assets, $31 billion in stated liabilities. Both numbers, the eventual investigations would establish, were significantly understated. The true gap, hidden in special purpose entities, was larger than the filing admitted. By the final trading session before bankruptcy, Friday the 30th of November, Enron stock had closed at 26 cents a share. Roughly a year earlier, it had been worth $90. What happened in the years that followed reshaped American corporate law. Within 72 hours of the filing, Arthur Andersen, Enron's auditor for 16 years, began shredding documents. In Houston alone, an estimated 2,000 boxes were destroyed. The 89-year-old firm, with 28,000 employees in the United States, was indicted for obstruction of justice in March 2002, surrendered its CPA license, and dissolved by the end of 2002. The Supreme Court would overturn the conviction 3 years later. By then, there was no firm left to acquit. On the 30th of July 2002, President George W. Bush signed the Sarbanes-Oxley Act into law. CEOs and CFOs would now personally certify financials under criminal liability, and a new public company accounting oversight board would regulate the auditors. Andrew Fastow pleaded guilty in January 2004 to 2 counts of conspiracy, agreeing to cooperate with prosecutors. In September 2006, he was sentenced to 6 years in federal prison. Jeff Skilling was convicted in May 2006 on 19 counts of conspiracy, fraud, and insider trading, and sentenced to 24 years, the harshest white-collar sentence of its era. A 2013 resentencing reduced it to 14 years. He was released from federal custody in February 2019, having served roughly 12 years. Kenneth Lay was convicted in the same trial on 6 counts of conspiracy and fraud. He never served his sentence. On the 5th of July 2006, while awaiting sentencing at his vacation home in Colorado, he died of a heart attack at the age of 64. Sarbanes-Oxley was supposed to make this architecture impossible. November 2022, the cryptocurrency exchange FTX collapses. $8 billion in customer deposits routed through Alameda Research, a related party trading firm controlled by the firm's chief executive. The valuations marked to internally generated models. The auditor signed the books. Same architecture, different decade, no utility connection at all. The lesson Enron taught was not about accounting rules. It was about the gap between what an institution reports and what it actually owns. That gap, every 20 years or so, is rediscovered. Next time on Empires of Money, The $11 billion accounting fraud that broke the largest bankruptcy record Enron had just set. 7 months later,